this strategy has one of the highest win rates you would ever see in the market. So if you're interested, let's get into the video. Now, the strategy deals with the Asian session liquidity. Now, I've explained this concept in my first video. You can check this out on the top right corner of your screen. That was part 1. So this is going to be part 2. Right, so let's get into it real quick. Now, if you've watched the previous video, you know what I'm talking about. You already know the strategy if you've been familiar with my channel. I'm going to be breaking this down more clearly. Now, we're going to first draw out our Asian box. Now, some people have been asking me the time zone for the Asian session, all right, for the Asian box in order to draw the box. Now, you don't really need to know the time zones. You just need to know where this line starts from on your platform. Now, on everyone's trading view, the line starts at the same time. My time zone starts at 21:30, I think. Yeah. So yours could be a different time, but it's still the same thing, right? So in order to get this session separators, you have to go to settings and go to appearance and session breaks, right? Once you turn this off, it will disappear, and once you turn it back on, it will be there, right? So now the Asian session it starts from here and lasts for about 8 hours. All right, so let's say this is 8 hours, lasts for about 8 hours. Now, what the market does during that period is, most of the time, 90% of the time, the market will spend its time consolidating inside that range. And now, there's one very important thing you need to know. Now, this box you see here, this Asian session box, has to be 25 to 50 pips. Has to be 25 to 50 pips. Right, so this from the highs to the lows measured has to be 25 to 50 pips. If it's more than 50 pips, then it's best to leave that pair alone, or leave that pair for that day, right? So leave it alone, right? If it's more than 50 pips, the ideal is 25 to 50 pips, right? So now, this consolidation, what does it do? It creates resistance and it creates support, right? And we know that traders sell at resistance and buy at support, right? So that means if people are buying and selling inside this range, right, mostly lower time frame traders, now what is going to happen is there's going to be liquidity at the highs and liquidity at the lows. Now, if we know that the liquidity is the stop losses of those buying and selling, and not only stop losses but also buy stops and sell stops, right? Because what will happen is, after the Asian session, coming into London session, you're going to have a stop hunt. We're going to have a stop hunt. Now, the stop hunt ideally is going to be also 25 to 50 pips, right? So, because most traders, when they enter sells in here or when they buy in here, their stop loss is going to be what? 25 to 50 pips below, or 25 to 50 pips above, right? So what the market does is it goes to that area and stop hunts that area, because that's where liquidity is, right? Them going upwards like this, what you usually see, this is usually very aggressive. So think about this. You had 8 hours of sideways consolidation. The market wasn't really going anywhere, bouncing up and down, just small price movement, 25 to 50 pips movement, not really much, right? And then all of a sudden you have a sudden burst in price out of that range, right? So this creates excitement in the market, right? And this is usually in the form of fast, aggressive candles. Now, what I mean by that is, all of a sudden you will see, in this example of the buy side, you will see fat green candles all the way to the highs like this, fat green candles all the way up. This is to create panic and also creates excitement, and at the same time hitting the stop losses of those that sold. When you get these fast candles out of the range, what usually happens is the last candle for the stop hunts, when they're done with the stop, but the last candle will end, most of the time will end with a pin like this. You will see like a wick like this, right? So they were going up, and then all of a sudden they pull back and then they close. Let's say this is an inverted hammer, right, or a pin or shooting star, whatever you want to call it, right? So what happens now is, this is now the high of the day. This is now the high of the day, right? HOD. So this is the high of the day. Now what will happen is, they have a lot of people trapped in here. You know, there are a lot of traders that don't wait for candles to close, so they buy in here as they see this candle going up out of excitement. And also the lower time frame buyers too are trapped in here. So what the market does is, it pulls back down, and then they will begin to consolidate below this high. They will consolidate below this high like this. This consolidation is also for the market makers to analyze their books and see if enough people are falling for this false move, right? So now, when they consolidate like this, what will usually happen is they will go back to that high, test the high, fail to break that high. Sometimes they might just throw a pin above the high like this and then reverse. That will be your M formation, right? And this structure, very important, this structure lasts for about 30 to 90 minutes or 2 hours, right? So 30 to 90 minutes or 2 hours. It can take more than 2 hours, well, usually 30 to 90 minutes, right? And up to 2 hours. This whole structure is better if it's up to 90 minutes, and it's better if it's up to 2 hours, because that means the M is a little bit more bigger, right? So once they form this structure, what they will do is they will shift away from that area with the second leg. The second leg will shift out of that area aggressively. Now this shift is done in order to shift immediately out of that area, to put the people who took buys all the way inside here, put them in panic, right? So if you bought in here, you're a buyer inside this area, and they shift out of that area, you're going to be in drawdown, and they're not going to come back, right? So they'll keep on going down like that, right? So this is the structure. Same thing for the W formation. So everything I said here also works inversely for the W formation, right? So let me just show you examples of that on the charts. Here's an example, right? So we see that the market consolidates, and then how many pips is this consolidation? This is about a 12 pip. You can see here 12 pip, 12.2 pip consolidation. This is perfect, right? And then what happens? All of a sudden we have sudden bursts out of that consolidation, right? All of a sudden markets goes out of that consolidation with fat candles. Now this is to induce people to take sales, right? Because the market has been dropping, right? All of a sudden they drop like this, so people see this as the famous continuation, right? So people take breakouts in here, right? Breaking below here. So there are a lot of people taking sales inside this area. Now what happens? We see that the market throws, you see this candle ends with a pin, right? And then what do? They go back and consolidate. You see the way they stayed above this. This was the low of the day. This was the initial low of the day, right? They stayed above this low, consolidated for about 45 minutes. They came back to test the low. They failed to break the low. They went back up. This is your entry, either here or here, right? So this is your entry on the second leg, either here or here. Now this structure took how many minutes? This structure took about 1 hour 15 minutes to form, right? So now all the people who took, so imagine you were taking breakouts, right? So you're going to take the breakouts when they break out of this consolidation, and when they break the low of the previous day, right? So now think about this. There are people taking sales here, people taking sales here, people taking sales here. All the way inside this range, people are taking sales. What do? The market goes down there, consolidates for about 1 hour 30 minutes, right? To get people to sell, right? And people see this as the famous continuation, right? Just for the market to shift out of that area with this fat candle. Once this shift candle comes into play, the people trapped in here are finished, right? And then they don't come back, right? And we see the same thing for the reversal at the highs. We can see that the market was going up, going up, going up, going up, right? And then all of a sudden we have this pin, right? We have these pins to the highs, and then what did they do? They come back down, they consolidate below that high, fail to go back to that high. You see this candle, this were fat candles going up, right? Then all of a sudden we have these pins to the highs. These pins are to trap people at this high, and then they drop, and then they consolidate for how many hours? Consolidate for about 1 hour 15 minutes, right? And they go back to test the high with this candle, right? So your entry is either here or here. The safer entry would be here. A more aggressive entry will be on this hammer, right? That failed to test this high, and then you take it back down like that, right? And then the day ends in consolidation. So here's another beautiful example. We see that the markets consolidated all the way in here, 17 pip box. This is good. Now we have them break out of this range, come back down. Now what happens? We see that the market goes up, gives us this pin in here, and then what happens? You draw a line like this, and you see that the market consolidates below that high of the day for about 2 hours 45 minutes, and then goes back to test that high with this candle here. So your entry is either here on the close of this hammer, here or here. Here is a little bit late because of this candle is like a shift candle, but you can still enter here. Your stop loss would be at the highs, right? A safe distance away from the market makers. If your stop loss is anywhere in here, you're at risk of getting your stop loss hits, right? So when you enter in here, you can see what they did. They consolidated for a while, for about 45 minutes, 45 minutes, right? And then all of a sudden we have this shift, right? This shift candle, this shift is to finish all the people who took buys in here. All the people who took buys in here, they're finished with this fat candle, right? And then the market reverses and never comes back. All right, so that is part 2. I think I might do a part 3 for this, because there's still a lot of information on this structure. If you've not watched part 1, make sure to watch part 1, the video on your screen. If you found this video helpful and insightful, subscribe to the channel, like the video, and I'll see you on the next one.